Is the American housing market about to break a level of unaffordability we didn't even know existed? The typical first-time buyer is now closer to 40 than 30, and that's ignoring the millions who will never own a home at all. We're seeing a surge in mortgages with just 1% down and repayment periods stretching to 4 decades. For the median household, nearly 40% of their income now goes just to the mortgage payment. And that's before you factor in taxes, insurance, and upkeep. In some metro areas, that figure rockets past 90%, which means one thing: the average family is completely priced out of the average property. For many, the only path to ownership is already having equity from a previous sale, with new buyers making up the smallest slice of the market in recorded history. The data looks bleak, but surely this is the peak of the crisis, right? Unfortunately, several powerful forces are lining up that could push prices into a terrifying new stratosphere. Take 25-year-old Zoe, who graduated college 3 years ago and is now back living in her old bedroom at her parents' house. Financial strain is the primary driver for these multi-generational setups. The so-called bank of mom and dad is becoming a major mortgage lender, and this is happening as big insurers retreat from certain markets. "I have to work impossibly hard just for a chance at a nice home one day," Zoe says. Now, before we dive into the devastating details, let's acknowledge a small glimmer of hope. The national median home price has actually dipped since its insane 2022 peak. Many point to this as proof that new housing policies are finally making a difference. However, this chart is misleading. The median price only reflects homes that successfully sell, and transaction volume is in a deep freeze. The National Association of Realtors reports monthly sales are down nearly 25% from pre-pandemic levels, and a staggering 40% lower than just 4 years ago. You likely know the core reason: the golden handcuffs of ultra-low mortgage rates. Homeowners who locked in rates below 3% will not sell, even if they move. They'd rather become landlords for their old property and rent in their new city. This trend is even more pronounced in other countries, so remember that point. This sales number is also skewed by the type of homes selling. Those forced to sell are often lower income, and the only properties moving are budget-friendly starter homes. The case-shiller index, which adjusts for these quirks, reveals a consistent year-over-year price increase. But even with these data nuances, we're just on the first tier of this global affordability crisis. Believe it or not, the American situation is relatively mild compared to many other developed nations. Our average house price-to-income ratio sits around 3.4. This rough metric shows how many years of average take-home pay are needed to buy an average house. It's imperfect, but it's a start. The UK's ratio is 8.7, Australia's is 8.4, and Canada's is a shocking 9.5. If our market morphs to resemble theirs, home prices could double or even triple overnight. So how is that even possible? 4 key differences separate us from them. Let's explore from least to most alarming. First, international data often standardizes home sizes to about 970 square feet. American homes are cheaper per square foot, but we've opted for sheer size over affordability, building vast, often flimsy structures. This is compounded by our cultural preference for living alone, a luxury that's fading fast. So, comparing a $500,000 McMansion to a tiny urban studio isn't entirely fair, even if our sprawl creates its own problems. But size alone doesn't explain the gap. If we miraculously decided to sacrifice our spare rooms, prices still have massive room to soar if we ignore several critical threats. One advantage that has somewhat insulated our market is our incredible population spread. It's not just our car-centric suburbs. We are dispersed across many cities. Demographers use urban primacy to measure how concentrated a population is in one megacity. In the US, only about 7% of people live in the New York metro area. That's a huge number, but it's low globally, meaning our real estate bets aren't all on one city. We have many significant urban centers. Combine our top 10 cities, and they still hold less than a quarter of our population. Now, compare that to Australia, where nearly half the population crams into just Sydney and Melbourne. This intense concentration supercharges prices. Everyone fights for space in a few hotspots, creating insane demand in tiny geographic areas. Less intuitively, it creates a winner-take-all investment dynamic, much like the stock market. Global hubs like London and Sydney attract so much capital that residents, unable to afford a home there, use their high salaries to buy investment properties in cheaper cities, renting them out to locals who can't compete. This rent vesting strategy is gaining traction here, thanks to those rate-locked homeowners who became accidental landlords. We are starting to export our housing crisis from wealthy zip codes to more affordable ones. A recent Bureau of Economic Analysis report found that just 31 counties now generate over one-third of the nation's entire economic output. As tech and finance giants consolidate, opportunities are concentrating. This is already causing home prices in superstar cities to detach from the rest of the country. For a two-bedroom apartment, New York is the least affordable U.S. city, with prices at 12 times the average disposable income. That's already in the ballpark of Sydney and Vancouver. The scary part? In those countries, half the population faces New York-level unaffordability. For now, most Americans have other options. But if job growth keeps concentrating, more of us will face a brutal choice: a good career or an affordable home. But it gets even more extreme. In cities like Beijing, Shanghai, and Taipei, that price-to-income ratio approaches an unimaginable 40. A person would need to spend over 3 decades of their entire post-tax income to buy a home considered tiny by American standards. These markets are often left off most unaffordable lists, but they reveal there is no natural ceiling for how bad things can get. Properties cost similar to major U cities, but average wages are far lower, so how does anyone buy? The homes are minuscule. The average American has about 900 square feet of living space per person. In Hong Kong, Shanghai, and Seoul, it's between 170 and 300. People afford this by pooling money across multiple generations and living in extremely cramped conditions under massive debt. While multi-generational living is more culturally ingrained, when 3 generations cram into a 2-bedroom apartment, it's driven by financial necessity, not tradition. Let me be clear. First, we are nowhere near this reality today. But second, it is dangerously naive to assume the housing market has a self-correcting mechanism. Without proactive policies focused on construction, lending, and development, nothing stops us from heading in that exact direction. In fact, the early signs are already here. For the first time in over 160 years, the size of the average American household is growing, despite lower birth rates, because more generations are living together. And for the first time in 50 years, the average new home is getting smaller. I'd love to say we're all becoming more family-oriented and eco-friendly, but let's be honest, we're being forced into it. If you want to understand why many proposed solutions to the housing crisis often backfire and make it worse, watch this video next. Final sentence, unchanged. And if this breakdown was helpful, please like this video and subscribe to the Winds of Thought channel to keep exploring the forces shaping our world.